Hello and welcome everyone. Today we are going to understand a term which is consistently in the news for past 6 months it is in the news, and it is having a significant impact not only in the Indian economy but in all emerging market economy. Right? The term is known as capital flight. Capital flight. So what is capital flight? What are the impacts of capital flight on Indian economy? We have to understand, because there is a strong possibility that the question in this upcoming prelims can be asked from this. And even if the question is not going to be asked, a good understanding of capital flight will help you to write and in fact tell about this topic even in the interview also, if the question is being asked on Indian economy in general. Fine. So what happened? When COVID hit all over the world, most of the economies went for lockdown. And that lockdown forced most of the economies to go for what? Stimulus. Why stimulus? Because all the economic activities were standstill. And in order to help the economy and people in general, central banks all over the world went for quantitative easing. Means they have decreased the interest rates so that demand can be picked. Fine. Similarly, government provided a lot of financial help to their citizens. So with this, what happened? The overall liquidity in the economy of a country starts rising. And then that causes rise in the inflation all over the world, including in the US economy. So the persistent rise in the inflation was cause of concern. But at the same time, central bank and government want to improve the financial condition of the system. So initially, central banks have not increased the interest rate. But when central banks found that inflation is breaching to certain level that is uncomfortable for them, then they started increasing the interest rate. Same thing happened in the US economy. Now, you can think why I'm talking about the US economy. I'll explain you, because we have to understand this term. That's why I'm talking about the US economy right now. So in US, last year, the rate of inflation breached 4%, which was historic high in the US economy. And in order to control the inflation, US Federal Reserve, that is the Central Bank of United States, they went for hawkish stance. We use this term hawkish stance in the economy when central bank is ready to do anything in order to control the economy, even at the cost of GDP growth rate. So central bank took the hawkish stance and they started increasing the interest rate. Now, interest rate on what? They started increasing the interest rate on lending to US commercial bank, and they also started increasing the interest rate on US Treasury bonds. Fine. US Treasury bonds. In India, we are used to listen these terms: T-bills, that is Treasury bills, and government bonds. Generally, bonds are long-term debt instrument and Treasury bills are defined as short-term debt instrument. But in US, rather than using this term Treasury bills and government bond, the term is used as Treasury bond. So Treasury bond is a US government security which is issued by US Federal Reserve. Fine. So US Federal Reserve have increased interest rates on Treasury bonds. So when the interest rate is increased on Treasury bond, and suppose I'm an investor from Germany or Japan or Brazil or any part of the world. So once I found that there is a higher interest rate is paid by the US Federal Reserve on the Treasury bonds, I will prefer to invest there. Fine. But I have already invested in India. So what I will do? I will give up my investment in India and I will withdraw my money from India and I will invest in where? US Treasury bonds. Fine. So, emerging market economies. Emerging market economies, India, South Africa, Brazil. So, all these emerging market economies started seeing this trend. What? The investors from all over the world, they started withdrawing their money from the emerging market economies and they started investing in US. Fine. So when investors start pulling out of their money because of some reason, here the reason is what? Rise in the interest rate in the US economy because of rise in the inflation in US. Fine. So when investors start pulling out of their money in order to get better investment value, we call this term as a capital flight, because the capital, their investment came to our country and that investment can be converted into what? Capital formation. So this capital formation is not going to happen because of this phenomena. So the term is used as what? Capital flight. Fine. Now let's understand how this capital flight will impact economy. Fine. So RBI is our central bank and RBI is also responsible to manage the exchange rate. Though we call our exchange rate as a market determined. Market determined means it is based on demand and supply. So when we say the exchange rate are market determined, it means the exchange rate are based on demand and supply of currencies in the market. But RBI under Foreign Exchange Management Act 1999 is empowered to intervene in this demand and supply system if RBI feels that the exchange rate are going to adversely impact. Means market determined exchange rates are going to adversely impact our economy, then RBI will intervene. This phenomena we do know as what? This phenomena we do know as a managed floating. Managed floating, and sometimes it is also known as dirty floating. Fine? Dirty floating. So RBI is definitely going to intervene if the exchange rate, specifically dollar to rupee exchange rate, is going to adversely impact our economy. So this capital flight will lead to what? From Indian economy, lot of outflow of US dollar will be there. If there is lot of outflow of US dollar from Indian economy, that will lead to what? Scarcity of dollar in the Indian economy. And if there is a scarcity of US dollar in the Indian economy, then obviously the value of dollar, suppose earlier it was 80 rupees per dollar, then this outflow will pressurize this exchange rate. Why? Because there is an excess outflow, and this excess outflow of dollar will lead to decrease in the supply. Fine. And then this exchange rate may be breached to 84. And if exchange rate will be breached to 84, what will be the impact on what? What will be the impact on import and exports? Export are definitely going to be benefited. Fine. Why? Earlier the exporter was getting 80 rupees, now they are getting how much? 84. That means there is clear-cut advantage in terms of export. But this extra advantage in export is going to be an extra cost on what? Import. Though we have to encourage the export, but for encouraging export too much, it will lead to what? A very adverse impact on our import cost, and it may lead to higher current account deficit. Means RBI is going to intervene. What RBI will do? RBI will start selling US dollar on its own in the currency market. Market is having the price of 84 rupees, and maybe RBI will start selling US dollar at the price of 82 rupees. So this selling of US dollar by the RBI is going to stabilize our exchange rate. Now the ability of RBI to sell this US dollar in the market is dependent on our availability of Forex, that is foreign reserve. So if we are having a good amount of foreign reserve, for example, India's foreign reserve is touching somewhere around $600 billion. So if RBI is going to take $50 billion from here, RBI will take $50 billion from here and RBI will start selling this US dollar, what? US dollar at the price of 82 rupees. Then RBI is able to stabilize this exchange rate. So any capital flight will lead to pressure on exchange rate, and RBI have to intervene in the foreign currency market to stabilize the depreciation of rupee. This is one impact. Fine. Another impact. Every central bank will sell their government securities. So US Federal Reserve is selling the government securities of US government, and they are what? Now they are providing higher interest rate to control the inflation. So if they are going to rise the interest rates on the government securities, and in general, in the bond market or the debt market, government securities are considered as a benchmark. Now, why they are considered as a benchmark? Because government securities are the most trusted securities in terms of return. So if you are going to invest in the government security, there is a 100% guarantee of getting the return in terms of principal amount and interest amount. But if you are going to invest your money on bankrupt government like Pakistan government, then there is a less possibility of getting the proper return. But in general, government securities are considered as 100% guaranteed investment. So in general, the interest rate on government securities are less in comparison to any other securities offered by private companies and all. Fine. So the interest rate, suppose that on the government security, RBI is offering 6.2% interest. RBI is offering 6.2% interest. So the rest of the debt securities which are sold in the market, they will have the higher interest rate than this. So this is why we call them as a benchmark in the bond market. So as I told you, every central bank is selling their government securities. Fine. So if US Federal Reserve is going to increase the interest rate on US government securities, that is treasury bonds, then the benchmark interest rate is going to rise, and most of the investors will look towards where? US market. Now if Indian government, which is also borrowing through RBI, and you want to attract the investors back to Indian market, then you also have to what? You also have to increase the interest rate on government securities in India. So any rise in the US government securities will put a pressure on Indian government securities to raise the interest rate. So this is the another impact. Means if US Federal Reserve is going to increase the interest rates on treasury bonds, then first there will be a capital flight. In order to control the capital flight, we have to what? We have to intervene in the currency market. And at the same time, we also have to offer what? We also have to offer higher interest rate on the government securities. That means cost of borrowing for government and other companies is going to what? Rise. So this is going to significantly impact overall economic activity because cost of borrowing is going to what? Rise. Fine. So in this way, rise in the inflation in the US. If the inflation is going to rise in the US, it is going to impact Indian economy also. Right? But here is a catch. What is the catch? When we talk about Forex, foreign currency reserve, fine. So generally our understanding is what? in general, our understanding as per the literature available everywhere is कि out of this foreign currency reserve, we have what? In the Forex, what we do have? We have foreign currency assets, plus reserve trench, where? In IMF. If you want to know about reserve trench, fine. And apart from the reserve trench, what we do have in our foreign reserve, that is our what? Our contribution to IMF, right? So our contribution to IMF is also part of what? Our foreign reserve. Fine. So here, rather than focusing on foreign currency, reserve trench, here I will focus, for your understanding, I'll focus on foreign currency assets. If you want to know more about in detail about how it is foreign reserve is made, what it is the reserve trench, and other component of this Forex, put a comment on this video. I will make a separate video on it. And apart from that, if you want to know any other thing related to the economy, put a comment. I'll make a video on it. Fine. But now let's focus on foreign currency asset, because it's a general perception among the students that this foreign currency asset means what? Dollar, euro, yen, pound, or the basket currencies. Yes, they are in the basket currencies, but they are not in the cash. We do not put the dollar in the hard currency form. This foreign currency assets are always, or most of the time, they are maintained in terms of what? They are maintained in terms of cash plus, for example, treasury bonds. So suppose India's foreign currency reserve is $600 billion. Fine, $600 billion. So out of this $600 billion, we have $128 billion worth treasury bonds issued by whom? Treasury bonds issued by US Federal Reserve. So what I want to let you know is, when the interest rates are going to increase in US because of the high inflation. So when the inflation is going to rise in the US Federal Reserve is going to increase the interest rate, and that interest rates are going to adversely impact in the Indian economy. Why? Because capital flights will lead to foreign currency market intervention by the RBI, and the benchmark interest rate in India is also going to rise. But at the same time, when RBI will see that what? The interest rates are rising in the US, RBI is also going to pick some amount of money from Forex, and it will start investing more in US Treasury bonds. Fine. So RBI will do this activity also. So at one instance, RBI is selling what? At one instance, RBI is selling $1 at 82 rupees in order to what? Stabilize the price. What is the market price? It reached to 84, but RBI won't settle it to 82. That is why RBI is selling at 82, less than market rate, in order to stabilize it. But at the same time, RBI is also purchasing US Treasury bonds. Fine. So that RBI can earn some extra interest on those securities. So this is how RBI is going to function as a manager of foreign currency assets under FAMAC 1999. So this capital flight have this amount of impact on what? This amount of impact on Indian economy. Fine. I hope you understand this video. If you want more video, such kind of the video, informative video, just comment on this video and let me know. I will make a video for your better understanding. Thank you.